Hi, I'm Manish Gunwani. I'm the CIO Equities at Nippon India Mutual Fund. We are very excited to launch our Flexi Cap Fund. And over the next few minutes, I will talk about why this is such an interesting product. So if you see the data on stock market performance, and we split it by three segments: large cap, mid cap, small cap. So large cap obviously are the very big companies, small cap are the very small companies, and mid cap is in between. Now, if you see over the last few years, there are times where each of these segment does very well. So if you see 2013-14 small cap did well, 2015-16 the mid cap did well, 2018-19 only the large cap did well, which was a very narrow phase of the market. So what we've seen across many years is that some part of the market does very well compared to the other parts. And that is where we see a big opportunity with our Flexi Cap Fund. So, what are the benefits of the Flexi Cap strategy? One is because you can invest across the market cap curve, you have a very large investment universe. Second is you can be dynamic between these various segments. So, if you can ride the cycle where mid caps do well, small caps do well, large caps do well, in those years you can create a lot of alpha. And therefore, this is a very rich strategy in terms of giving choice to the fund manager to create outperformance. Now, let me talk a bit about why the outlook for equities in general is very interesting. Now, we've seen a massive crisis, a once in a 100-year crisis, which is the COVID crisis. And India in particular has suffered more because we've had two waves, out of which the second wave was quite strong. In spite of that, after the first wave, where markets globally corrected a lot, what we have seen is the markets have done very well. And even though India went through a very torrid second phase, the markets kept doing well. So, question is why? So, I think the important point here is that we are approaching the end of the crisis because with vaccination rollout accelerating, what we are seeing is the number of cases, the number of deaths globally has started falling significantly. So if you see the way the global economy has recovered, it is more or less in line with how the virus crisis panned out. So China did well initially, then US and UK have started recovering. And we believe that over the next year or 2 years, the emerging markets, particularly India, have a very bright chance of recording very high economic growth relative to the historic standards. The other mega trend which is helping equities is that globally central banks, which control the monetary policy of the large countries, they have been very aggressive in supporting the markets with liquidity. So if you see the balance sheets of the central banks, they have actually exploded over the last 10 years. And this liquidity obviously helps all asset classes, but equities particularly has benefited a lot from from this injection of liquidity. Coming to India, I think probably the biggest reason to be positive on Indian equities is that we are coming out of a very strong down cycle in earnings, which is now turning around. And therefore, the outlook on corporate earnings is very, very positive. So, for example, in FY21, even though India, because of the virus, went through a very bad phase for the economy, we saw that corporate earnings actually grew. And what we have been seeing is that over the last 12 months or so, consistently the corporate earnings for next 2 years have been getting upgraded. In spite of the second wave, which impacted India, We've seen these upgrades happening in spite of that. One of the big reasons for that is that a lot of corporate earnings actually don't depend on India itself. If we break up the market, a significant part of our company's earnings, they come from the global economy. So we have large export-driven sectors like IT, auto, pharma, and we also have lot of earnings coming from sectors like commodities, which are more linked to the global economy. Another big reason why the outlook for equities and the Indian economy remains very robust, and this is a very secular reason, is that if you see Indian households over last many decades, they have built a very robust balance sheet. So roughly $8 trillion of assets is what Indian households own, and the debt against that is quite minuscule. Also, even in this last 12 to 15 months, across the two waves of the virus crisis, the wealth has actually gone up. So, if you see what Indian households own in financial assets, which is largely bank deposits, equities, all that has gone up in value, thus helping the balance sheet get even better. So, given these positives about virus crisis fading, good liquidity, strong corporate earnings outlook, we believe that the FlexiCap investment strategy is ideal for the current time. So, let me talk a bit about the fund strategy going forward. So, we will have in this fund both large caps and mid and small caps. From a risk management perspective, we have capped the deviation from the large cap weight in the index to 50%. So we will have large caps in two buckets. One will be mega caps, which will have small deviation from the index weight. And then we will have another bucket which will have active divergence to create alpha. On the mid and small cap side, we will look for bottom up stories, structural stories, which will grow fast and hopefully become large caps later. The focus will also be on a lot of new age businesses. As we all know, we are living in an age of disruption, and we believe that a lot of businesses with new interesting business models will emerge in the mid and small cap space. And our effort will be to ride the growth in those business models to create great returns. So, let me talk a bit about our strategy on large caps. What we are seeing in very big sectors as well is that there is a lot of consolidation. That is, the share of top two, three players is going up a lot. And this is broadly happening because of two reasons. One is because of technology itself, which is allowing large players in banking, etc., to scale up very rapidly. The other reason is regulation, where if you see what has been the reform in the last 5, 6 years, which is GST, RERA, etc., all these reforms have led to a situation where, because of compliance, again, the leaders in each industry, they are getting market share. So we will have a focus on these plays on consolidation. Also, with the domestic economic recovery looking very bright in terms of potential, we will have large caps which are a play on economic recovery. And thirdly, we believe that over last 3, 4 years, what has happened is that in each sector, the richly valued stock has done better, and the divergence in valuations has become quite large. So across sectors, we believe that some of the lower valuation stocks, they will do better in the next few years, and our effort will be to capture that divergence. Coming to mid and small caps, we have a fairly rich diversity of themes which we are positive on. So one is again over last 15 months, because of the virus crisis, We saw a lot of businesses which rely on outdoor consumption. They went through a very tough time and stocks have suffered as a consequence. But with the recovery in travel, recovery in tourism, etc., we see a lot of these businesses coming back to the growth mode. So whether you talk of retailing, multiplexes, beverages, travel, aviation, etc. The second is similar to large caps, but in the domestic economic recovery theme, there are a lot of mid caps which are very cheap versus the large cap players in the same segment. So, for example, cement, real estate, etc. This trend is very visible, and we believe that the mid cap stocks will outperform the large caps. Thirdly, um, as was mentioned, basically there are a lot of new business models which are emerging, and a lot of these stocks are coming in the mid and small cap space. So whether it is e-commerce, whether it is fintech, aggregator platforms, gaming companies, we will obviously be very keen to drive the growth of these companies to create alpha. The fourth segment is segments where there are no large caps virtually, right? So the leader itself is a mid cap. So in India, even very prominent segments like consumer durables and hotels, there are no large caps. So the mid and small cap players obviously look interesting. And finally, a big structural theme where stocks have done well, but we still think there is a lot of potential to go, is the China plus one or manufacturing for import substitution theme. So within this, there are various segments like chemicals, electronic manufacturing, pharma, API. Now, these stocks are a bit rich on valuation parameters. But if we see from a market cap versus the potential opportunity size, they still look attractive selectively. Overall, we will obviously be very inclined towards quality companies because we tend to buy and hold these companies for many years. So we will obviously have a big focus on ensuring that corporate governance, management quality are of the highest order. So to conclude, basically, if you look at the Indian equity markets today, there are concerns about the price to earning multiple being very high and overall the valuation levels in the market. We believe that with a strong corporate earnings growth outlook for next 2 to 3 years, and the fact that also interest rates are at a very low level, these positives counter the high price to earning multiples, and overall, we can expect the market to compound steadily over the next few years. So we believe that the Nippon India Flexi Cap Fund is ideally positioned to capture the potential opportunities in this healthy market. Thank you, and we look forward to your participation in the Nippon India Flexi Cap Fund NF.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.